All right, let's dive into something that might seem a little dry at first, but I promise is way more interesting than you might think. We're talking banking regulations. Yeah, today we're unpacking Basel 3.1 near final rules.
Not exactly a beach read, I'll grant you that, haha. But these rules, they're surprisingly interesting, I promise. And more importantly, they directly affect your financial life, even if you don't work in a bank.
Okay, so less too boring to care. More, pay attention. This could affect my wallet. Convince me.
Absolutely. Think of these rules as like the financial system's safety net. They're there to, prevent another 2008-style meltdown, the kind that can really tank the economy and make it way harder for you to get a loan, or even keep your savings safe, frankly.
Okay, nobody wants a repeat of that. So Basel 3.1 near final rules. This is like us getting a sneak peek at how banks will be regulated, right?
Exactly. Think of it as getting a glimpse into the financial crystal ball. We can see the direction regulators are heading in. We can understand the potential impact and maybe even spot a few curveballs while we're at it.
And I'm guessing, like most things in finance, impact means it's complicated.
It is complex. There's no doubt about that. But that's where we come in. We'll cut through the jargon and really just zero in on the parts that matter most to you. First up, risk weights. Now imagine, just for a second, trying to compare the risks of lending money to, say, a giant tech company versus lending it to your neighbor for a home renovation.
Tricky. One's probably got a much flashier credit score than the other.
Exactly. And that's the challenge banks face every day, figuring out how to measure risk across completely different types of loans. Risk weights are basically their solution. Think of it like a credit score for banks. But instead of it impacting your ability to get a loan, it affects how much money they need to keep safe, just in case.
So a risk weight is assigned to each loan, and the riskier the loan, the higher the weight.
You got it. And the higher the risk weight, the more capital the bank needs to hold as a buffer against potential losses. It's all about making sure they've got enough cushion to absorb those losses without triggering a domino effect that could, topple the whole system.
Makes sense. I see in this document that some assets, like certain government bonds, they get a risk weight of 0%, while corporate debt gets a much higher weight. Why such a huge difference?
It really all comes down to perceived risk. Governments, especially stable ones, they're seen as incredibly reliable borrowers. They have the power to raise taxes or, in theory, print more money to pay off their debts.
So lending to them is seen as practically risk-free.
Mm-hmm.
But what about those times when a bank wants a little more freedom in how they assess risk? Is there ever any wiggle room?
That's where the IRB approach comes in, internal ratings-based. It's kind of like giving banks a little more autonomy, but, with strict rules, of course.
Trust but verify.
Exactly. With IRB, banks can use their own internal models to assess risk, but regulators are watching their every move.
So it's like letting a chef create their own recipe, but a food safety inspector is right there the whole time making sure everything's up to code.
Perfect analogy. And the document actually highlights just how closely they're being watched. Article 143D states that even small changes to a bank's risk model need approval. It's serious business.
Wow, talk about being under a microscope. It sounds like regulators are learning from past mistakes and really trying to prevent banks from underestimating risk.
Exactly. They're trying to strike that delicate balance between giving banks some flexibility while also protecting the stability of the entire system.
Speaking of stability, what about real estate? It seems like everyone wants to invest in a condo on the beach these days. But how does that factor into these risk calculations?
Real estate. It might seem pretty straightforward on the surface, but valuing properties for banking purposes way more complex than just checking Zillow. Location, property type, even the loan terms, they all play a role in determining the risk weight.
So a mortgage on a shaky underwater house in a volatile market would get a much higher risk weight than a mortgage on a solid property in a stable neighborhood.
Precisely. And here's where it gets really interesting. Article 124 focuses on UK commercial real estate. It states that banks can only classify it as low risk if historical losses were below 0.5%. That's incredibly strict.
Why such a tight leash on UK commercial real estate? Were they building castles on sand over there or something?
Not quite, but the UK did experience a major commercial real estate crash back in the early 1990s. This rule seems like a direct response to that, a way of saying, we've learned our lesson and we're not taking any chances this time around.
Wow, that's a powerful example of how regulators are using these rules to learn from past crises and try to prevent history from repeating itself. Welcome back. Last time, we kind of dipped our toes into the world of risk weights and real estate valuations. What other regulatory rabbit holes are we diving into today?
Get ready, because we're about to explore a concept that sounds like it's straight out of a financial thriller: CVA risk.
CVA risk. Okay, that does sound a little ominous. Should I be worried?
It's not about hiding your money under the mattress or anything, haha, but it is about understanding a critical aspect of financial stability. Remember the 2008 crisis? One of the major culprits was something called, counterparty risk.
Right, that whole too big to fail fiasco. But remind me, what exactly does counterparty risk even mean?
It's basically the risk that the other party in a financial agreement won't hold up their end of the bargain. Think of it like this. You order a custom-made bike, pay up front, and the bike shop goes bust before delivering it. You're out the bike and the cash.
Ouch. Not the best feeling, especially if it's an expensive bike. So how does this relate to CVA risk?
CVA, or credit valuation adjustment, risk really zooms in on a specific type of financial agreement: derivatives. It's the risk that the other side of a derivatives contract might, default, leaving a bank high and dry.
Derivatives. Those are complicated financial instruments, right? Aren't they risky enough on their own?
They can be complex, yeah, but they also act as a sort of financial insurance. They help banks manage various risks. But just like with any insurance, there's a chance the insurer might not be able to pay up when a claim is made. That's the essence of CVA risk.
So it's like buying insurance for your phone, but then the insurance company goes bankrupt when you drop it and crack the screen.
Exactly. And after 2008, regulators started to realize that banks weren't always accurately accounting for this risk, which could have, disastrous consequences for the entire system. That's where Basel 3.1 comes in.
Lay it on me. How does Basel 3.1 tackle this whole CVA beast?
It lays out very specific methods for banks to calculate and manage CVA risk, really making sure they're not underestimating the possibility of things going south.
So it's not enough for banks to just say, yeah, we've considered that, someone might not pay us back.
Mm-hmm.
They have to show their work, prove they've actually thought about all the what ifs.
You got it. Article 325 BP in this document is a prime example. It mandates something called a quantitative impact assessment. Essentially, banks need to demonstrate that they understand how their models could be wrong, and importantly, how they'd handle those errors.
It's like telling someone, don't just assume your GPS is always right. Have a backup plan in case it sends you down a dead-end road.
Spot on. It's about building in safeguards, acknowledging that models aren't foolproof, and preparing for unexpected detours. It's all part of creating a more resilient financial system, which ultimately, benefits everyone.
Right, because a more stable financial system means a more stable economy overall. So we've covered risk weights, IRB, real estate valuations, and now CVA risk. It's like we're building a financial fortress, brick by regulatory brick.
And we're not done yet. There's another crucial aspect of Basel 3.1 we need to unpack. The operational risk framework. This one hits close to home for every bank, no matter how big or small.
Operational risk framework.
Yeah.
That sounds pretty important. Fill me in on what makes it so crucial. Okay, operational risk framework. It sounds a little, bureaucratic, but I have a feeling this isn't just about filing paperwork. What exactly are we talking about when we say operational risk?
It's really about all the things that could go wrong inside a bank, even if their investments are doing great. Think like human error, a rogue employee, a system glitch, a natural disaster taking down their servers, anything that disrupts how a bank operates on a day-to-day basis.
So not just about making bad loans, but about the potential for things to go haywire internally.
Exactly. And these risks, they're becoming more and more important these days, especially with cyber attacks on the rise. One well-placed hack can have a way bigger impact than it did, say, a decade ago.
Right. It's like the difference between someone robbing a bank vault and someone just shutting down the entire banking system with a few keystrokes. So how does Basel 3.1 address this?
It creates this comprehensive framework, like a risk management playbook for banks. It requires them to actually have systems in place to identify, assess, and manage these operational risks. We're talking everything from background checks on employees to cybersecurity protocols to having really solid disaster recovery plans.
So it's not just hoping for the best, but actually preparing for the worst case scenario.
Precisely. And it's not a one-size-fits-all approach either. A small local bank faces different risks than a global financial giant, right? Basel 3.1 recognizes this. It provides guidance on how banks should tailor their approach based on their size, their complexity, and their own specific vulnerabilities.
Let's think, you wouldn't expect a corner store to have the same security measures as Fort Knox.
Yeah.
But they both need some level of protection, right?
Exactly. And the goal isn't just to prevent bad things from happening altogether, which is impossible, but it's also to minimize the damage if and when those things do happen. This is where stress testing and scenario analysis come into play. Banks need to run simulations, imagining those what-if scenarios, a major cyber attack, a pandemic, a rogue trader trying to, outsmart the system, and they need to demonstrate that they can handle the heat when those things happen.
So it's about being proactive, not just reactive. Having a plan A, B, and maybe even C up their sleeve.
Absolutely. It's all about building a more resilient financial system, one that can withstand shocks and prevent those domino effects that can impact the entire economy.
Well, we've covered a lot of ground in this deep dive. Risk weights, IRB, real estate valuations, CVA risk, and now operational risk. It's clear that these regulations are incredibly complex and really interconnected.
They are. But there's a common thread running through all of it. Building a safer, more stable financial system. And that's something that impacts every single one of us, whether we're reading balance sheets for a living or just trying to, buy groceries.
Absolutely.
Yeah.
When the financial system is healthy, it's good news for everyone. Thanks to your expert insights, I feel like I've leveled up my understanding of how these regulations work and why they actually matter.
My pleasure. It's been fun, diving into these details with you.
And a huge thank you to you, our listener, for joining us on this deep dive into the world of Basel 3.1. We've only just scratched the surface here, but I hope you found it as fascinating as we have. Be sure to check out the show notes for more information on this, complex but crucial topic. Until next time, stay curious.